Hi friends, in today's video, I am discussing a question which is there in ICI study material, but where students have asked us a lot of doubts. So it is on a model called portfolio replication model. It is a model of valuation and where students have found it little difficult to understand this. Maybe some concept level gaps could be there because of which some difficulties have been faced by student. This has been coming in MTP RTP. It got tested in November 23 exam. It was part of May 25 RTP. So a question on this may end up getting tested in exam. Before I start discussing the question, I just want to show you a PDF which we have prepared giving the resources available. So in case you want to download any material of mine, the resources available, I have a priority question material, third edition material for question bank, the theory material, charts book, everything is there. The link of this I'll add it in the YouTube the video. You can just download these material and then download whichever material you need. Now coming back to this question, it is on portfolio replication model. Let me read out the question and then I'll explain the two concepts which you have to be aware. Mr. Dayal is interested in purchasing equity shares of ABC Limited, purchasing equity shares of ABC Limited, which are currently selling at 600 each. He expects, so it's currently at 600. He expects that price of share may go up to 780 or may go down to 480. There are two judgment prices. It can go up to 780 or go down to 480 in 3 months. Probabilities are given in the question: 60% probability and 40% probability of chances of occurring these variation. There's a call option on ABC Limited which can be exercised at the end of 3 months with a strike price of 630. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? If he is planning for a perfect hedge, if he is planning for a perfect hedge, what should he do? What should be the value of option today? And what is the expected rate of return on the option? Let me take this question just a minute. I take it to this place and we start doing it now. This is the question. I am interested in buying equity shares of ABC Limited, which are currently selling at 600 rupees. I expect the price can touch 780 or go down to 480 in 3 months. Probabilities have been given in the question. If the probabilities are given in the question, you cannot follow risk neutral model of valuation. Under risk neutral model, we calculate probabilities. If you are aware of risk neutral model, it will be good to understand the linkage between risk neutral model and this model. In risk neutral model, we compute probability and then do the valuation. Here, first thing they ask for a perfect hedge. For a perfect hedge, we need to be aware of a concept called delta. Now, what is this concept delta? Let's understand this. Delta basically measures how much is the change. This is AFM charts. How much is the change in the call premium for a change in the share price? Call delta, call premium change for share price. Put delta, put premium change for share price change. And call delta is normally positive. Why is it positive? If share price goes up, the call option premium will go up. When share price is going up, there's a high probability of call getting exercised. So call premium will increase. And put option as a negative delta. Negative delta means like we have beta for a share, here we have delta. Call option as a positive delta, put option as a negative delta. Positive delta indicates that share price will change positive side, call premium will change positive side. Share price goes down, call premium will go down. Call premium will go down. This is as far as call option delta is concerned. There is a positive delta for call option and there is a negative delta for put option. Put option as a negative delta, call option as a positive delta. Now, how do I calculate delta? Let's understand. Now we have given price and intrinsic value of call option. What is intrinsic? Is real worth of the option. We have been given two judgment prices. Price can be 780, price can be 480. Our strike price is 630. So in a call option, do I want to buy at 630 when the price in the market is 780? Yes. Do I want to buy at 630? That's how we calculate the intrinsic value. Do I want to buy at 630 when the price in the market is 780? Answer is yes. Intrinsic value is 150. 780 minus 630 is the intrinsic value. Do you want to buy at 630 when the price in the market is 480? No, I don't want to buy. So the difference in call premium is 150 rupees, the intrinsic value. Difference in price is 300. Delta is difference in call premium or call price divided by the share price. So delta is equal to change in call price or option price divided by change in share price. When share price went up, call premium has gone up. 0 has become 150. When share price went down, that is why it is called positive delta. So what this means? 150 minus 0, 780 minus 480, 0.5 is the delta. 0.5 delta. What does 0.5 delta mean? Let's understand that. 0.5 is the delta. The call option has a delta of 0.5. Now, what does this concept mean? If you have a delta of 0.4, just take an example, delta of 0.4. If you have a delta of 0.4, it means one call option is equivalent to only 0.4 share. One call option is equivalent to only 0.4 share. There's something called as a riskless portfolio which we create. What is riskless portfolio? Taking either buying the share and going for writing of call option, because when you buy the share, price goes up, you make profit. And if you write the call option, you buy the share, price went up, you make profit. On the other side, what will happen is on the call option, if price goes up in the market, premiums will increase, and if you are a writer means seller of the option, you will have a loss. One place profit, one place loss. So next, delta hedging. Here we had a format: security, delta, weight, product. I have share, I have call. Share has +1 delta, because we are finding out how is the change in option price as compared to the change in share price. What is delta of share? Change in share price by change in share price. Call had a delta of 0.5. Overall delta I want 0. Overall delta has to be 0. That is called riskless hedge portfolio. Overall delta has to be 0. You can either buy one share or half a share. I think solution talks about half a share, so let me do half a share only. 0.5 share I buy, multiplication 1 into 0.5 is 0.5. 1 into 0.5 is 0.5. Overall total has to be 0. If overall total is 0, this is minus 0.5. Overall total 0. And this weight is column 4 divided by column 2. Minus 0.5 divided by 0.5, minus 1. Minus 1 means you have to sell one call option and buy half a share. Sell one call option and buy half a share. Other option for this is we could have done one share. That means two call option you have to write. Buy one share and two call option. So for hedging purpose, we are going to do buy half share and write one call option to create riskless hedge portfolio. Buy half share and write one call option to create something called as a riskless hedge portfolio. What is riskless hedge portfolio? Is profit from half a share will offset the loss of writing one call option. Our other option is buy one share and write two call option to create riskless hedge portfolio. Buy one share and write two call option. You can go for writing two call option or one call option. So both the ways will give me a riskless hedge portfolio. Only thing is, in one place I have to buy, in another place I have to write. Reason is very simple. If I buy in one place and write in another place, profit from one place will offset the loss from other place, and that is where the second part of the question. What does the second part of the question ask? It says, what combination will give you a perfect hedge? Okay, in fact, in an exam question they asked even this. Here they have not asked how will the investor maintain an identical position. I'll show that. How will the investor maintain an identical position at the end of 3 months? Identical means when I buy half a share and write one call option, I should get same value. I should get same value whether the price is 480 or 780. So price can be particulars. Price can be 480. Price can be 780. I bought by 0.5 share. This is my asset. I've already purchased it. This is my asset. This will give me 240 rupees, 390 rupees. This will give me 240 rupees and 390 rupees. By 0.5 share, 240 and 390. 240 and 390. By 0.5 share, 240 and 390. 240 and 390. Then I did writing. Write one call option. This will give me a loss. A writer will suffer a loss. No exercise. 150 rupees loss. So 240 I will get it after 3 months. 240 I will get it after 3 months. 240 I will get it after 3 months. After 3 months we will get 240 rupees, and this is how we are going to value the option now. How are you going to value? It's a very good approach. 240 rupees is the value of the option. We are replicating. Why it's called portfolio replication model? We are replicating a riskless portfolio. Now, concept is very simple. After today, day 0 and month 3, I'll get 240 irrespective of whatever be the price. Irrespective of whatever be the price, whether it is 480 or 780, I'll be getting 240 rupees. Which means what can I pay today? What can I pay today? Obviously lesser than 240. I'm going to get 240 rupees after 3 months. I'm going to get 240 rupees after 3 months. I'm going to get 240 rupees after 3 months, which means I have to invest something today. How much can I invest today? Obviously less than 240. Time value of money into picture. A very good concept. What is time value of money? Risk-free rate is 10% per annum. I'll discount this to today. So 240 discounted by 1 plus 2.5%, 3 months, 10% for a year, 10% for a year. I discount this to today value. I discount risk-free rate is 10% per annum. I discount this to today's value. Let me open Excel. We'll discount it to today's value. 240 divided by 1.025. So today I will pay 234.15. I will pay 234.15. And what you pay today is, you pay for half a share. This is your outflow, and you receive premium on call option, because we are writing today. Premium on call option. This is inflow. This 234.15 which I paid today is for buying half a share, but I'll receive something. What am I receiving? Premium on call option. How did we create a portfolio? We bought half a share, wrote one call option. This gave me 240 rupees in the end. Today I paid 234.15. 234.15 in that share is today worth. Share is today selling at 600 rupees. Practically half share is not possible, but to solve the question, we are taking half share. Today I paid 300 rupees for the share, half share. Half share, we have paid 300 rupees. And premium on the call option is my inflow balancing figure, and I value the option. Premium on call option is my inflow. Net outflow is 234.15. So this is my inflow 300 minus 234.15. 300 minus 234.15. 65.85 is what I will be getting as an income of the call option if I'm a writer. And if I'm a buyer, I have to pay 65.85. I'll explain this again. We had originally two prices, 780, 480. We computed the intrinsic value. How do you compute the intrinsic value? Basics of option you have to be aware of. But concept is very simple. Do you want to buy at 630 when the price in the market is 780? Answer is yes. 150 is the difference. That's the intrinsic value. Then we calculate the delta. Delta is change in option price by change in share price. 150 minus 0 by 780 minus 480. Half is the delta. Half is the delta. Now we have to create a riskless hedge portfolio. What is riskless hedge portfolio? Is share as a delta of 1 time, call option as a delta of 0.5 time. So combination of that, I make it as combination half share and 1 call option. Minus means writing, plus means you are buying half a share and minus 1. Half a share, buy half share, write 1 call option, So buy 0.5 share, write 1 call option. On the maturity, both will give me 240 rupees. Today, I will obviously pay lesser than 240, 234.15. How did I pay 234? 300 rupees for share I paid, and for the call option, one option I received 65.85. I received 65.85. The next part is expected rate of return on the option. Now that probability will come into picture. Rate of return on the option is now option payment. Payment is 65.85. Payment is 65.85. We are paying 65.85. Either we are receiving or paying, doesn't matter. It's a call option. The value today is 65.85. Then on last day, price can be 480, 780. If it's 480, people will get 0 rupees. And if it is 780, people will get 150 rupees. And they have given probability. They have said the probability of you expect price may go up to 780 or go down to 480. 780 or go down to 480. Chances are 60 and 40. 60% chance for this. I will earn 90 rupees. My investment is 65.85 if I'm a buyer of the call option, and I will get 90 rupees in the end. And if I'm a seller of the call option, my inflow is 65 and my outflow later is 90. Basically, I'll have a loss or I can have a profit. So finally, rate of return. Rate of return is equal to this formula. I have already told many students what I get back minus what I give. What I get back minus what I give divided by what I give into 100 if you do normal answer, into 12 by m you do annualized return. What I get back is 90. What I give is 65.85 divided by 65.85 into 100. This is the rate of return on option. 90 minus 65.85 divided by 65.85 into 100. 36.67 percentage. This is for 3 months. You can convert this into annual return by doing 12 by m. 36.67 into 12 by m. 146% something, which is the return we will make. We cannot use the risk neutral model if the probabilities are given in the question, because we have to compute the probability for risk neutral model, and if you compute it, you may get a different probability. The probability somewhere I feel is wrong in the question. If you do the calculation, you may end up getting a different probability. This is what the concept of replication model is concerned. If you look at the solution of ICI, they would have done almost the same thing. Presentation could be little different. So first they calculated delta change in option price 0.5. So Mr. Dayal should purchase 0.5 share for every one call option. Then they did value of option today for valuation. 240 rupees is the value, price is 780, and again 240. 240 is what I get it in the end. 240 is what I get it in the end. And this 240 today I will be paying 240 divided by 1.025, which is 234 point whatever number, I think 234 point number 234.15, which is half share outflow and premium inflow, and return on option is 90 minus 65 divided by 65, 36.67% for 3 months. For a year it is going to be 146%. With this discussion on replication model is over. This is a usual doubts of students, so I have discussed a video. Any other question you have, doubts you want me to discuss, you can just type it here. I'll see if time permits, we will discuss those questions. Thank you, friends.